Welcome friends and pilgrims to the Investor's Sanctuary. Welcome to the Temple of the Dividend Discount Models, where we will worship at the altar of present value. Sorry, but that's what it seems like to some people. It seems like hocus pocus, magic, and all that kind of stuff. But really, it's not that difficult. Once you understand the concepts, it really is not that difficult. The trickiest part is understanding the concept. Doing the calculations are actually pretty straightforward, especially when you use a spreadsheet, which we're going to learn how to use. So we are going to have to get past the understanding, and by doing so, we will have found a very, very potent tool in our efforts to become prudent, long-term investors and ultimately successful and wealthy. Okay? I hope you're ready, because this stuff is so much fun for me, and I hope it will be for you. And as in our previous presentation, do the calculations and the understanding will come soon enough. Slide number 17, dividend discount models. Shares of stock are valued on the basis of the present value of the future dividend streams the stock is projected to produce. What does that mean? In other words, what is this company going to produce in the form of dividends in the future? Yeah, that's how we're going to value the stock. They are called dividend discount models, dividend valuation models, discounted cash flow models. Recall from our previous presentation that we believe, fundamental analysis believes, and we're doing fundamental analysis here, that the value of a stock is based on the present value of its future cash flows. Therefore, dividend discount models should be extremely popular, right? Well, not always. During the 1990s, investors who adhered to these types of models were considered old-fashioned, outdated fuddy-duddies. Yeah, those investors weathered the 2000 to 2002 downturn very well, because they said, you know what, capital gains are all well and good, but dividends don't lie. Dividend is money in my pocket. And it turned out in the late 1990s that many of these companies were going down, while the technology and the media companies and the telecommunication companies were all skyrocketing. Yeah, well, those remember, the NASDAQ lost 80%, technology companies, the S&P 500 lost 50%, and interestingly enough, some of the companies, the defensive companies that paid dividends, actually went up in the 2000 to 2002 downturn. Did it help in 2008? No. Everybody went down. Dividends have become important again. Well, as far as I'm concerned, they were always important. But now dividends can be spoken of in polite company once again. Slide 18. The dividend discount model in its purest incarnation says that the value of the stock is equal to the present value of all the expected future dividend payments. What are you talking about? Well, it's math. I know it's scary, but let's walk through it. Relax. The price at time 0, meaning today, the present value, is equal to the first year's dividend, that's D sub 1, divided by 1 plus K. What is K? Well, in baseball it means strikeout, but in finance and investment, K is usually the variable we use for required return. So in other words, what do we expect out of the stock? What's our, 8%, 5%, 10%? And so for the first year, you divide the dividend divided by 1 plus the required rate of return, 5%, 10%, whatever it is. And then the second year, dividend, D sub 2, dividend in second year is divided by 1 plus the required rate of return squared. And then the third year, dividend in the third year divided by 1 plus K, the required rate of return to the third power, and so on and so forth through time. So I know it's scary, it looks scary, but it's really just doing a very simple calculation. And here it is, the example on page 181 of 7th edition. If you have an earlier edition, it's very similar. It's there somewhere. This is a company that's paying $100 per share annual dividends. And our required rate of return is 15%, which I told you I think is ridiculous. But in this case, what we do is we take $100 divided by 1.15, 1 plus 15%. That should look fairly familiar. And then we take $100 the year number 2 and divide it by 1.15 squared, plus $100 in the year number 3 divided by 1.15 to the third. And assuming the company goes out of business after 3 years, then we should believe that this stock is worth to us $228.32. But how many businesses pay 3 annual dividends and then go out of business? Right. Plus, we keep using this term present value. What does it mean? Did you ask yourself throughout the first presentation, Piano, what are you talking about? What is present value? Did you ask yourself today, as we're going through this, what is present value? Well, on slide number 19, we see that the present value is the value today of a lump sum or a series of payments. You remember, if you went back in chapter 1 and did the future value calculations, we looked at what the value is going to be in the future of what we put away today. Well, what we're doing now is we're doing the opposite. We're looking at what the value today of some cash flow that we receive in the future. You didn't have to do the work in chapter 1. You could go and just look at the results, or you could do them, but we're going to do them now in chapter 6, but we're going to go in reverse. For example, if we put $10,000 today and we get 8% or we require 8%, then in 10 years, that $10,000 will be worth $21,589. And that's the formula, but don't worry, you don't have to use it. You use the future value tables, and we're going to use the present value tables. Likewise, if we're going to receive $21,589 in 10 years, and we believe we want 8%, then today, that $21,589 that we get in 10 years is worth to us $10,000. You see, present value and future value are just two sides of the same coin. In finance, present value tells us what that future value that we receive sometime in the future is worth to us today. Now, what's the tricky part? Right. Do we know that we're going to get that much in the future? No, we're just guessing, but still, this is how we put a valuation on our best estimate. So, slide number 20. Did the formula for the dividend discount model scare you? Well, yeah, it's a scary formula because it uses exponentiation, but we're not going to do that. Remember, I told you all you need is a calculator that will add, subtract, divide, and multiply. That's all. You don't need exponentiation. You don't even need square root. All you need is add, subtract, multiply, and divide. So what's going to happen? We're going to use the present value tables, which you're going to need for the next few slides. So you can stop now, or the next slide is the link to them. So hang on. So then what happens is the formula becomes the dividend in year number 1 times the present value multiplier. That's what PVM stands for year number 1. And then we add the dividend for year number 2 times the present value multiplier for year number 2. Are you getting the idea? Dividend number 3. So you don't have to do exponentiation. You don't have to solve that funky, scary looking formula. You just do some multiplications and then summations, and we're going to see that a spreadsheet makes our life a whole lot easier. So, slide number 21. Let's do the same example over again, but instead we're going to use the present value multipliers from the present value table. So, if you haven't if you have a big screen, fine, you can just bounce back and forth. But I recommend printing it out because it'll make your life a lot easier. And there it is on the website. Let's do the same example. 3 annual dividends of $100, and the required rate of return is 15%, which I think is outrageous. But you go across the 15% for year number 1, and you see 0.870. Now, if you haven't done that, stop the presentation and do it, because this is very important, folks. You're going to learn how to do this. By the end of the semester, you're going to do it so many times that you're going to be seeing it in your sleep. You're going to be seeing the present value table in your sleep. So start now. $100 times 0.870. Well, that's $87. And what is that telling us? That's telling us, would we rather have $100 a year from now or $87 right now? And if we require a rate of return of 15%, which again I think is outrageous, it doesn't matter. The present value of $100 1 year from now at 15% required rate of return is equivalent to the $100. I'm sorry, I said that wrong. I apologize. Start again. The $100 that we get a year from now, if we require a 15% rate of return, is equivalent to $87 now. That's the present value of $100 in 1 year at 15%. And we go out to 2 years, go down one more row, year number 2 on the present value table, and you'll see it is 0.756. So we multiply 100 times 0.756, and we get $75.60. So today, that $100 that we get 2 years from now at 15% is $75.60. And then I hope you got the idea now. The third year, 0.658, multiply $100 times 0.658, and you get $65.80. And so that $100 that we're getting 3 years from now is worth to us today $65.80. And if you add those three amounts up, you get $228.40, which is, about 8 cents off. And why is that? Because the table is not exact. If you were to do the calculation and you're using 20 digits of accuracy, we're only using 3 digits of accuracy. So the sum of the present values of the future dividend cash flows equals our perceived value of the stock. And I know that may sound a little tricky, but if you do the calculations enough, it will sink in. And if you change the required rate of return to 10% or 5%, exactly, you see the perceived value change. And that's why we said in the first presentation, value is in the eye of the beholder. How much return do you want from a stock? So what is that stock worth to you? Well, it depends on your required rate of return. As we'll see, because we're going to do a few problems where we do it with 8% and we do it with 6% or 10%. You just play around and see that the values change. Slide number 22. So let's take a look at some variations of the dividend discount models before we go back and look at that pure form. The zero growth model, which is not covered in our book. Well, it is. They just don't say it. The zero growth model is we assume that dividends will continue at a fixed rate indefinitely into the future. And it's a very simple calculation. We take the annual dividends and we divide them by the required rate of return. So if we take a company that's paying us $3 a share and our required rate of return is 6%, then we take $3 divided by 6% and we get $50 per share. That is what we would expect to pay for a stock if we require a 6% rate of return. Does it look familiar? Well, it should, because it's simply another way to view the dividend yield. And you math fans will go, oh yeah, you just swapping the numerator and denominator. So here, the value of the stock is equal to the annual dividends by the required rate of return. Well, what we're doing is we're swapping the required rate of return with dividend yield and the market price with the value of the stock. So you see the dividend yield is the annual dividends divided by the market price. Well, the market is dictating what the market price is. Our value is what we believe it is. And instead of dividend yield, it's what we require. So investors, and if you didn't understand that, don't worry about it. But for you math fans, you'll say, oh yeah, I see what they're doing. Investors who emphasize the zero growth model are valuing the stock almost exclusively for its dividend yield. In other words, I don't care what happens to the capital appreciation. You keep paying me my dividend, and I'm a happy man or woman. And so let's take a look at a real-life example on slide 24. This is a company called Edison, Consolidated Edison, Edison Electric. And they're one of the oldest electric companies in the country because this is the electric company for the city of New York. Con Ed, Consolidated Edison. And it's a utility stock. So yes, it's a income producing stock. And so as of March 2nd, 2017, the price was $77.19. And they were paying $2.76 per year in annual dividends. And their dividend is very stable. Every once in a while it goes up a little bit, but no, it's very stable. So if our required rate of return is 8%, we take the $2.76 divided by the 8%, 0.08, and we get a price of $34.50. The stock is selling for $77. That to us it seems too overpriced. We're not going to get our required rate of return. What if it were 5%? What if we said, we'll be happy with 5%? You take the $2.76 divided by 0.05. Do it. Come on, you make sure I didn't screw up. Check your calculator to make sure I didn't screw up. And you'll find that the stock should be worth, in our estimation, $55.20. Well, I don't know. I mean, it's selling for $77. So with a market price of $77.19, the stock is yielding approximately 3.6%. We have to look somewhere else. We're just not going to get the kind of return we want to get because we're not assuming any capital appreciation. Does that make sense? If not, go back and listen to it again, do the calculation, and you'll say, oh, I got it. Yeah, it makes sense. I understand. They're just looking at the stock as if it were only going to produce dividends, and that is it. Who worries about whether the stock goes up or down or not? Does that make sense? Go over it again. You can do it. We want you to be awesome. Okay, let's continue. So, the constant perpetual growth model is really just the zero growth model with an added term, actually two terms, to take advantage of the fact that for this stock that we're looking at, we're assuming the dividends will continue to grow at a specified rate perpetually into the future. In other words, the zero growth model, the dividends were constant. They weren't going anywhere. In this model, they are constantly growing, which is, I get the dumb name, constant perpetual growth model. I didn't make it up. But in other words, your dividends are going to continue to grow. And there are many companies that have been doing this for decades. They have been consistently growing their dividends. They tend to be the blue chips, the very large companies that have their roots deep in the economy. So here is the formula. It's essentially the same as the previous formula. Remember, the previous formula was annual dividends divided by the required rate of return. But in this case, what we do is we multiply the dividends times 1 plus the growth rate. Sound familiar? That's what we did in the previous presentation, right? 1 plus 6%, 1 plus 8%, whatever we believed that they were going to grow at. And then in the bottom, we take that required rate of return and we subtract out the growth rate. So the example in the book, which is not the best example, you got a company that's paying $10 per share in dividends. And so, excuse me, if we believe that the annual growth rate is going to continue to be 5%, then next year they'll be paying $10.50. And again, 15% is, I think, too high a rate of return, in my humble opinion. So you take the $10 times the 1.05, that's $10.50, and you divide it by 15%, minus 5%, and that's 10%, 0.01. And if you do that calculation, you get $105. Or this stock should be worth $105. But let's take a look at some real life examples. And so here we are on slide number 26 looking at 3M. 3M? You don't, maybe you've heard of them, maybe you haven't. That's the new name. It used to be called Minnesota Mining and Materials, but now it's 3M. You use their products all the time. You don't even know it. Some of you, Scotch tape, Post-it notes, right? They make thousands of different products, most of which are flat, like reflective tape and things to wrap houses and the like. And so their current market price as of the March of 2017, $189.89. And they are paying $4.70 in annual dividends. Again, well, no, let's assume that dividends are growing around 8%. Okay? Let's assume that dividends are growing around 8%. And our required rate of return is 13%, which I think is a little high in my humble opinion. But if you do the calculations, and again, the calculations are easier than the concepts. You take $4.70 times 1.08, 1 plus the growth rate, 1 plus 8%, and you divide that by 13% minus 8%, which is 5%. And so you get $5.76 divided by 0.05. That's what 5% is, 0.05. And you get $100, $101.52, which, if we're requiring a 13% rate of return, it's nowhere near the $189, $190 that you're paying for the stock. But what if we simply reduced our required rate of return? Because in my humble opinion, 13 is too much to ask for anyway. If we reduce our required rate of return to 10%, then we get the same calculation on top, $4.70 times 1.08. But this time the denominator changes, 10% minus 8%. And we get the 5.0760, a little over $5.07, divided by 0.02, or $253, almost $254. What a deal! This model is very sensitive to our choice of our required rate of return. Try it for 5% or 15%, and you'll see that the numbers just go all over the map. Which, again, I know maybe you didn't like my quote from Germany. That's what makes horse races. Everybody looks at a stock and sees a different what they expect. They expect a different required rate of return. They see a different value. Making sense? That's why investing is so exciting, because there are millions of investors all around the world judging stocks differently. And so we have to join them. We have to get in the river and start swimming. And hopefully these techniques are going to help you swim with the good, I don't know if this analogy makes any sense or metaphor, but hopefully you're not going to drown, right? You're going to swim with the good currents. They're going to take you downstream and you'll enter the ocean of wealth. Oh, ridiculous. Anyway, let's go. Let's continue. Do you think 3M is a good value? Maybe, maybe not. You have to do more research. This is just the beginning. Slide number 27, McDonald's. Yeah, all right, McDonald's. I would never eat there, folks, but sometimes you buy the product and not buy the stock, and sometimes you buy the stock and don't buy the product. But again, another blue chip stock, current market price a little over $128, paying $3.76 annual dividends. We will again assume that the dividends are growing around 8% per year. And if our required rate of return is 13%, do the calculation. It's not hard. 3.76 times 1.08. That's a little over $4.06, 4.0608. Divided by 13% minus 8%, 0.05. And you get $81.22, which McDonald's doesn't quite measure up if we're looking for 13%. in this model. What if our required rate of return were only 10%? Then we do the calculation again. Well, this is the same, $3.76 times 1.08. But this time we divide it by 10 minus 8% or 0.02. So the $4.06, 08, divided by 0.02 is over $200, $203. So the model says that McDonald's is undervalued if we require only a 10% rate of return. Do you think people all around the world will ever wake up to the fact that they are being sold an expensive and unhealthy combination of sugar, salt, and fat? No, neither do I. Which is why we might want to invest in McDonald's, but don't buy their crap. I mean, their food. Don't buy their food. It's not good for you. Not good for you. But okay, once a month, or not every day, like some people do in the South where they voted for Trump. Anyway, slide number 28. Constant perpetual growth model, real life example number 3, Coca-Cola. Number 1 brand name in the world. There's only 1 or 2 countries where you can't buy it. I think there's 1 country left where you can't buy the stuff. Current market price was $42.47. Currently paying $1.48 in annual dividends. Assume dividends are growing around 8% per year, as we did with the other 2 stocks. Our required return is 13%. Go through and do the calculations, and you find that it's worth about a little over almost $32, $31.97. I'm not trying to be too precise here, folks. And so, so much for caramel colored fizzy sugar water, right? Not a very good deal. If we require 13%, which in my humble opinion is too much to require. If we reduce our required rate of return to 10%, then we get $1.48 times 1.08, or almost $1.60, divided by 0.02, or almost $80, $79.92. Maybe we ought to spend more time researching Coca-Cola, because in the United States, the average person drinks over 400 Cokes a year. Now, I have a hard time believing this, folks, because there's some of us, like me, who don't drink any. I can't stand this stuff. It makes your teeth hurt. But there are people who are drinking 800 Cokes a year to make up for those of us who don't drink any. And in China, the average is 38. In India, it's 12, and it's growing. 20, 30 years ago, they didn't drink any. Guess which country drinks the most Coca-Cola? Ustedes que tienen parientes en su país. Ustedes saben, right? In Mexico. Mexico, they drink over 700 Cokes a year. And it used to be that Coca-Cola would publish this information. And they don't do it anymore. Why? Because people like me put it on our websites and show how bad, just how bad it is, and how it's causing obesity, and they've sort of acknowledged that, but at the same time they sort of say it's not really our problem, No, we privatize the profits and we socialize the costs because it's society's problem to deal with the people who get diabetes. I digress. Remember, we're in this to make money, right? Well, this is a as with McDonald's, this is a societal phenomenon that economists call moral hazard. It's in McDonald's and Coca-Cola's best interest to sell as much crap. I mean, bad food and fizzy sugar water as possible, but they don't have to deal with the costs of the diabetes. Right, exactly. And then people get angry and say, well, the nanny state, you shouldn't be telling people how much Coke they should be drinking, how much hamburgers they should be eating. Yeah, but we're all paying for it, folks. We're all paying for it. So there's that eternal struggle between the privatization of the profits and the socialization of the costs and the mess that the society has to pick up. So think about it. After you've made money from Coke and McDonald's. Slide number 29, General Electric. The current price, you've heard of General Electric? Yeah. They're the oldest stock in the Dow. They're the only stock that was in the Dow when it started in 1896 and is still in the Dow Jones Industrial Average. The market price is $30.19, currently paying 96 cents in annual dividends. Again, let's assume that dividends are also growing at 8% per year. So if we do the calculation for 13%, we get $20.74. And not a very good deal if we want 13%, but if we want 10%, then it turns out that GE is a pretty darn good deal, almost $52. But this is after GE dropped its dividend down to 40 cents from $1.24 in 2009 after decades of growing the dividend. What happened? Well, the financial business was destroyed in 2008 and 9. We bailed out the banks, folks. And GE, by that time, was now making more money in their financial arms. You see, you think of GE as making power plants and locomotives and jet engines. They do that, yes. Don't get me wrong. They do that, but they also have a leasing company and an insurance company, and they owned NBC for decades, and they were making more money off their financial end of the business than they were off the industrial end of the business. And they got hammered in 2008 to the point where they needed some cash. They needed money. And who did they go to? Mr. Warren Buffett, who had plenty of cash waiting for the disaster to strike, and bought $5 billion of GE. And GE was very happy to take the money, although it came with serious strings attached. You buy when there's blood in the streets. You buy when everybody else is running for the exits. And GE did not die. GE has come back. In 2010, they started raising the dividend again, first to 48 cents, and then to 56 cents, and 60, 68, 70 cents. You see, they're aggressively growing their dividend back up, and they probably will get to $1.24 before long and be very happy that everything is behind them. Pretty amazing, isn't it? Yes. So if we require a 10% rate of return, GE appears to be a good value. Is this the only thing we're going to look at? No, we're going to do more research. This is just one model, one statistic. But as we said at the beginning, we hope that you will see that these kind of calculations tilt the odds in our favor and allow us to remove the emotional of, well, it's going to go up, it's going to go up, it's going up, maybe it's going to go down. No, we look at it as a long-term investment and say, hey, those dividends don't lie. Those dividends are growing and they make it worth this much to us. Okay, let's take a look at our last example, Altria. Altria, you've heard of Marlboro and Virginia Dims, Slims, Virginia, yeah, they sell cigarettes. Used to be called Philip Morris. And they were so huge at one time, they owned Kraft and Miller and Post Cereal and Oscar Mayer, and they also, they sold all of them off, and then they finally sold off their international sales of cigarettes, and that company is called Philip Morris International. It's based in the United States, and it doesn't sell any products in the United States. It sells all its products outside the United States. That's how crazy the world is. But Altria still sells Marlboro and Virginia Slims here in the United States. And the current market price as of the 2nd of March was $75.72. They're currently paying $2.44 in annual dividends. Again, let's assume that dividends are also growing around 8% per year. If we take that same required rate of 13%, then $52.70, we think the model says that it's overvalued. How about 10%, huh? 10%, do the calculations. The model says that the company should be worth $131.76, almost $132. What a buy! What a buy! If you conveniently ignore the fact that tobacco kills 400,000 Americans each year. You want to invest in a company who sells a product that when used as directed kills its consumers? Well, yes, as a matter of fact, yes, you do. It's cigarettes. How much does it cost to make a cigarette? A little over a penny, and they sell 20 of them for $8. It's a very lucrative business, and this company, and Reynolds and British American Tobacco. They're just waiting for the feds to make marijuana legal, and they're going to swoop in just like the beer companies and the alcohol companies, because vices make a ton of money. Would you buy Altria? Would you? Yeah, well, think about it. Because sometimes you buy the product and stay away from the stock, and sometimes you buy the stock and stay away from the product. In my humble opinion. Let's continue. Uh-oh. Who's that? Who is that?
No.
Yeah, who are you? Who are you? What are you doing here?
You know who it is.
It's my conscience.
Come clean.
Come clean about what?
Fess up.
Fess up about what?
Where did you get the assumed dividend growth, huh?
I made him up.
Huh?
I made him up. All these companies are growing their dividends faster than 8%.
That's better.
Ooh, I hate it when my conscience bothers me like that. Dear students, the constant perpetual growth model is very sensitive to the assumed growth rate of dividends. We used 8% as an example, but the recent dividend growth rates of 3M, Coca-Cola, GE, McDonald's, and Altria are all currently higher than 8%. Coke and McDonald's are 8.3%, Altria is 9.7%, 3M is 10.9%, and GE is 11.7%. But the model does not work if the required rate of return is equal to or less than the dividend growth rate. You get division by zero or negative prices, which don't make any sense at all. So therefore, we should actually raise our expected rates of return for all these three companies. All are actually better buys than what the model is telling us for our 13% or 10% rate of returns, because we have to raise the growth rate. And this is only for a rarefied group of blue chip companies with long histories of rising dividends. But they're not alone, folks. They're not only just a few. They're companies that you've heard of, folks. ExxonMobil, Procter & Gamble, United Technologies, Honeywell, Johnson Controls, Ford. Check them all out. In fact, that's what the bonus assignment for Chapter 6 is to actually dig in and take a look at companies now from a much more granular level. I don't know if that makes any sense, but you're getting in there and looking at what these companies are producing in the past from dividends and saying, hey, this is what I believe it's worth. Now, remembering, do we know that they're going to continue to grow? Exactly. We don't know what's going to happen in the future. But I believe it will tilt the odds in your favor. It will make your likelihood of success, albeit long term, you're not going to hit upon an Amazon, a Netflix, a Titter. It's not going to explode or implode, but you will build wealth slowly. Excited? I am. Works for me so far. Every time I've used these tools, it's done pretty well. And when I was speculating about a company exploding on the upside, they all did well, but I didn't get out in time. They all imploded. Slide number 32. In your book are a couple more models that we're not going to use. The constant growth model, which assumes dividends will grow at a specified rate for a specified number of years. No. Folks, it's the constant perpetual growth model. Here's the constant perpetual growth model. The dividend, D sub 0, times 1 plus the growth rate divided by the acquired rate of return minus the growth rate. That's the constant perpetual growth model that we just did. And then we add this term to account for the growth for a number of years, 5 years, 10 years, whatever. We're not going to use this one. You can use it if you want. You can do the problems in the book and use this for a company that you're interested in. You say it's going to grow at this rate for 5 years. It's going to grow at this rate for 10 years. And you'll get a much more precise and, I think, unreliable number. And then slide number 33 is the two-stage dividend growth model, which takes the growth model on the previous slide and takes it one further. And now we are getting ridiculous, folks, in my humble opinion. It may look impressive, especially if you love math, but it has some serious problems. It's very difficult to accurately predict future dividend growth during the initial fast growth stage of a stock, because usually companies do not pay significant dividends while they are growing quickly. But more importantly, now you probably can't read that quote where it has right here if you're looking at it on a small screen, but many decades ago, Benjamin Graham, who was Warren Buffett's teacher, wrote The Intelligent Investor, which you're eventually going to read. He warned against using overly sophisticated mathematical models to value stocks, especially any model that removes judgment from the equation and basically lets the computer decide what to buy. You see, so far with these models, folks, we are just, as I said in the previous slide, we're just putting our finger up and seeing which way the wind blows. We're looking at the sky and saying, oh, it looks like it's going to be sunny. It's going to look like it's going to be dark. We're not relying on these things to be precise because they aren't. Okay, so we're not going to do the constant growth model, the two-stage dividend model on the last two slides. If you want to, go ahead. They're not that hard, especially if you like math, but I'm not going to use them. Slide 34. So, observations of the dividend discount models. Okay, time for a break. All right. How do you use them for a company that isn't paying any dividends? Well, the simple answer is you can't. If a company isn't paying dividends, then you're looking at an annual dividend of 0, and you multiply 0 times anything and you get 0. So in other words, a company that is not paying dividends is not worth anything to us if we rely on dividends for the valuation. The constant perpetual growth model is usually an unrealistic assumption, except for that rarefied air, that elite group of companies, blue cut chips that have been around for decades, that have been paying Johnson & Johnson, Procter & Gamble, companies that have been paying dividends for decades. And dividend growth rates are very difficult to estimate. With large cap, well-established companies, historical growth rates may be useful. But with fast-growing companies and new industries, well, it's almost impossible. But the problems of the dividend discount models notwithstanding, repeat after me. The value of a stock. I want to hear you all say it. The value of a stock is based on the present value. Is based on the present value of its future cash flows. In other words, what is it worth to me? It's worth to me what it's going to be producing in the future from the cash flows that I receive in this model, in these models that we dealt with today, in the form of dividends. But, oh boy, dear students, because when we come back, you're going to see a model, which is another variation of the dividend discount model, that allows us to value a stock even if it doesn't pay any dividends. In fact, this technique is so powerful, we can use it for virtually any investment. Oh boy! So we'll see you in our next presentation when we take a look at the discounted cash flow model. Oh boy, this is so much fun! See ya!